Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now.
So Upstart has had a pretty volatile last several months, right? They had a really big run. They were sort of the darling of Wall Street for a while there, and it's come kind of crashing down ever since. So what happened in terms of what the market was expecting and investor sentiment compared to the actual fundamentals of the business?
Yeah, so here's a chart you can see. It is certainly the stock climbed an absolute mountain and then flung itself off of the other side, and like you said, has certainly been volatile along the way. So a couple of things have happened. So number one, that peak, that was kind of the peak for a lot of tech stocks, a lot of growth stocks. Let's be honest, Upstart was trading for an extremely high valuation at the peak that the business certainly hadn't earned. The expectations were very, very high. And quite frankly, the business in the couple of quarters after that delivered pretty well, delivered really, really great growth and solid results. The market simply wasn't rewarding the company for a couple of reasons. Number one, the revaluing of the market in general that we've seen, and 1A, what we've seen in terms of the economy, right? Rising interest rates, rampant inflation, concerns about recession. All of that ties to Upstart's kind of their core business and their main business today, and that is unsecured consumer lending, right? So just personal loans that are not secured by an asset as collateral. So you have a mortgage and your home secures it, right? You don't pay the mortgage, they can come take your home away from you. You have an auto loan, they can repossess the loan if you default, or they can repossess the car if you default. With these personal loans, there's no collateral besides your credit rating. And with Upstart, it's like, well, we're not, we're doing something different. So people might even say, well, what am I really risking here? And let's face it, when people start to have to make these tough decisions economically, their hours get cut at work, job opportunity shrinks, lose a job, something like that happens. You start to prioritize your debts, right? And you have a home loan or you have an auto loan, you're going to pay those because you don't want to lose your house. You don't want to lose your car. But if you have credit card debt or a personal loan it's not secured, that's something you might say, well, I'm just going to have to pay late on this, or I might even miss it for a month or two, but I've got to make ends meet, right? So Upstart's business is at the leading edge of the credit risk if the credit cycle does turn, right? So that's one of the things that we've seen with the market and reevaluating its business. Now, if we go back 2 quarters ago, it reported quarterly earnings. And again, its business is the platform. It's not the lender, it's the platform. And then it has financial partners that are lenders that take those loans, and then they either keep them as investments or they bundle them together and sell them to other investors that want the yield income that those loans generate, right? So the thing that happened was the company reported, and it carried a larger amount of loans on its books than the market was expecting. And investors kind of freaked out, Jeff. They kind of freaked out when that happened because there was concern about, well, is the market starting to turn? Is it having trouble? Is it carrying these over because it doesn't have somebody ready to buy them? Why are they still on its books, right? And it created a lot of questions about the viability of its business, and also some concerns about are they changing their business model?
So as you're looking forward, and if some investors are listening, or current shareholders or people who are thinking about buying shares of Upstart, what are some specific things we all can look for in the coming quarters as they, report their results that will tell us whether some of the risks you just identified are getting better or getting worse?
So I think the key is there's been a lot of noise about Upstart the past couple of quarters that it's reported. And I think by and large, it's caused a lot of investors to lose focus on the real kind of the signal here with the business. And again, the reality is even when it was generating triple-digit growth and record earnings in the quarters prior to this last one, I think revenue grew 18% this last quarter. It wasn't terrible. It's still a pretty solid quarter. We really still didn't know everything we need to know about Upstart. And that's how can its algorithm, its credit worthiness process of determining risk, how good does it really work, right? So we haven't gone through a full credit cycle, right? It feels recession-y to a lot of people. We just saw Ford announce they're going to lay off some people. A lot of tech companies have started to cut jobs. But we still haven't seen like a full recession where, we're dealing with millions of jobs getting cut that we see like in like, I hate to use the term, but a normal recession, right? When we see that sort of recessionary environment, that's when we find out how good lenders really are at underwriting, right? That's when we find out. And until we go through that full cycle and we find out how loans that Upstart were originated on Upstart's platform 2 years ago, until we find out how those loans do through a full credit cycle, we're really not going to be able to fully evaluate the strength of its business. So I think that's an important thing to remember, is that as much as those quarterly results are important to look at and to understanding how loans that it's not even, doesn't even have anything to do with anymore, that are on some investor's balance sheet or sitting on one of its bank partners' balance sheet, that's when we're going to really learn about the quality of its business over the long term.